Alphabet is committing over $100 billion a year to capital expenditure, while Broadcom reports a $73 billion backlog for specialized AI hardware. When this level of corporate spending meets financial projections in the tens of trillions, it creates a big market delusion, a cycle where investor overconfidence outpaces the actual evidence of profitability. This unchecked enthusiasm has valuation experts deeply worried. They warn that the scale of this build-out could trigger a market downturn far more intense than the dot-com crash of 2000. The danger is structural. For years, the tech industry thrived on asset-light models, where companies wrote software and avoided heavy physical costs. AI is forcing a reversal of that entire character. These models require massive physical footprints. Companies are now defined by their rows of server racks and specialized processors, which requires a complete shift in how investors calculate their value. The tech sector is now anchored to the most expensive, highly leveraged physical infrastructure gamble in its history. The dot-com bubble of the 90s was fueled primarily by equity. Investors bought shares, and while those shares eventually lost their value, the financial damage was largely restricted to those individual portfolios. Because that era required very little traditional capital expenditure or R&D, there was almost no physical footprint to liquidate when the companies failed. The current AI cycle is built on a different foundation. It relies on massive, long-term investments in physical infrastructure, including multi-billion-dollar power grid upgrades. Unlike the equity-heavy funding of the 90s, a significant portion of this modern build-out is being financed through corporate debt. Debt creates a rigid obligation that equity does not. These loans must be serviced regardless of performance. A failure to generate immediate revenue leads to defaults, spilling the crisis into the broader financial system. The CapEx payback funnel tracks how hardware spending becomes survival cash flow. First, raw capital becomes usable compute, fighting physical bottlenecks like grid capacity. Next, companies must secure paid enterprise demand. Finally, this demand must become free cash flow to pay down the massive debt. But an external threat looms: strict U.S. government regulations on frontier models due to safety and national security concerns. If regulations slow innovation, it weakens AI compute demand. This domino effect could shatter the revenue projections of the entire semiconductor sector. The industry has committed to an equation requiring near-perfect execution. If adoption falters or innovation is restricted, the math supporting these trillions in debt collapses. If the monetization of AI fails to keep pace with the cost of the hardware, the tech giants will eventually lose the ability to service their massive debts. This mirrors the mechanics of the 2008 financial crisis, where excessive lending and interconnected debt magnified a localized problem into a global economic event. When foundational infrastructure fails, the pain doesn't stay restricted to Silicon Valley. The defaults ripple outward, damaging the credit markets and the broader economy through systemic spillover. And this leads to a chilling paradox. According to valuation experts, the ultimate outcome of the AI boom presents two equally difficult scenarios for society. In the success scenario, AI meets its $20 trillion projections. But that level of success implies a scale of human job displacement, causing massive societal disruption. The failure scenario is the capex trap. The hardware bubble bursts, the debt goes unpaid, and the economy is dragged into a deep recession. We are caught between two structural shifts: a systemic crash triggered by a debt-fueled bubble, or a period of societal upheaval driven by total automation.